Hello investors, hopefully you are having a very good times. In today's video, I will cover how to continue our journey on the Google Spreadsheet side and focus mainly as Google Spreadsheet as a tool, but focus on the applied portfolio rather than on a single stock. So in last video, I have covered how to create a portfolio tracker which will automatically update every day the price update, and it will show you the Google gain and loss and portfolio value. In today's video, what I will do, I will go one step further and take two assets price and compute its assets risk, the not compute the portfolio risk and return, and try to show the correlations between them. So from the risk and return, we understand, okay, return, we always see the return in my channel when I do the stock valuation, whether this stock is good or not. But that's from the single stock perspective, right? So how we should minimize the risk of the portfolio, and also want to see whether if I have existing stock, is it makes sense to add another stocks that we can see from if the portfolio risk is reduced or if the correlation is less, right? So these are the things is very important. So I have one stock, let's say this is my so I'm using the Google Spreadsheet again because it's give very fast the historical price. As you can see, I have already taken the Google price. Don't worry, I will show you how to do that just to save time. So from 2015, right? So I have taken this price, right? So let's take the other one, right? So the from the first of from the January 1st, right? So let's take the another and until now, right? So right now it's, as you can see, this is October the 1st, right? So the month and date, right? So it's the second, so pretty much is go T minus 1. Okay, so let's take the another stock. So it's very easy, rather than in early days we used to go to the Yahoo Finance and go to the history and download the stock price. So next stock which I want to take is the non-technology stocks, and Walmart is, I already did the stock valuation of Google and Walmart on my channel, so which shows whether it's a good value stock or not. So okay, so let me tell you what so in order to pull the price, so what I need to do, I'll use the same Google Finance function, right? And here I will give the Walmart as the first symbol, as a ticker name, right? And then next I need to give the attribute. For sure I need to give the price up to this level. This is pretty straightforward, right? But now in order to get the historical price, what I'll do, I'll use the date function of Google and give me, and I'll put the starting date. So for sure I'll want to be consistent with the Google, so that's why I give 2015. Month I'll give first, and date I will also give first, right? I close this parameter. Now it asking me what is the end date you want to give. So for the end date, I'll just want to give today's date, right? And I'll just enter it this as well. Okay, and so I have given this one, and for daily I can simply enter the daily word, or also can type 1. Let me try 1. Close the bracket and press enter. Okay, so I got the, within a second this spreadsheet gave me the price, right? This is the Walmart price. Okay, so now I have these two price. So what I will do, I'm basically copy this data, Control C, and paste as a value, right? Because I want to work on these stocks. Right click, same thing is, and paste values only. Okay, that's great. Okay, so I don't need 2 times date, so I'll delete this column. Maybe I'll delete this one as well. Okay, so this is the Google, and this is the Walmart, right? And I'll just delete this. Okay, I'll delete this one as maybe I'll just okay, hide. Okay, so now I have this date and to price. So the very first thing, in order to compute, so I want to compute the daily return. Okay, so to do the daily return, so I'll say Google return, and then I'll compute the Walmart return, right? To do the daily return, I can simply use the log function, and actually so I'll do the ln. I'll just give this date and date minus previous date, and if I close the bracket and press enter, okay, so maybe I'll little bit zoom it, so hopefully now it should be much easier. Okay, so what I have done, I have created the 1 day return, right? So from this t and t minus 1, right? So today's time divided by yesterday times in the log, and then I just double click it, and boom, it populates me the return, right? Similarly, I will do for Walmart. I'll just drag this here, right? It automatically picks up my formula just like the Excel, right? And then double click. So now I have these daily return from almost 5 years, right? It's from 2015 to 2020 October, right? Okay, now what I need to do, I need to calculate the mean, and standard deviation, right, of Google. Maybe I'll just use this one, Google and Walmart. Okay, now it's pretty straightforward to do the compute the return, how much return we'll get from the Google. So we can just use the average function and give this column name. Okay, I just click on the heading and close the bracket. I'll give the full series. So don't worry, it's too low because this is the daily return. Okay, similarly for the standard deviation, there is a function std, this one, right, dot s. I'll give the whole series and enter. Oops, dooms, and it's giving me the standard deviation. So pretty much, right? So this is my daily return and this is my standard deviation. To do for the Walmart, I just need to do the same thing. So rather than typing, I just drag this formula here. Let's see if it picks up. Yeah, it picks up the right values. Okay, yeah, right value. Okay, so this is my daily return and the daily standard deviation. So next thing is I also want to see what is my portfolio correlation, right? So pretty much if I'll see on the risk side, right, so the return is coming this and this. Okay, so if I do the correlation of the stocks, how the correlation means how these two returns are, whether if it's a tightly correlated, this means if Google return takes A, Walmart also go A, right, or X value, they are follow the same path. But if it's non-negative correlation, which is the best, right, because then if it goes X, other will go Y. So this means we have more diversification. To do the correlation, we just do CORREL. I'll take the Google return, comma, the Walmart return, and then press enter. Okay. So the correlation between the Google and Walmart return is 30%. So it's still less than 50%, and it's better. I'll expect them to be 10-15, but it's not bad, right? So that's how it is. So let's see how. So that's on the correlation side. Okay, we can also see this if you want to see in a graph. If I want to see the chart, I can select these twos and try to see if what chart Google is offering me. Oops, looks like it's a line chart. Do we have a scatter plot? Yeah, this one. So this is the scatter plot chart. So it's yeah, so it's 0.3 is right here, right? Okay. Anyway, so I'll just delete this one because we can see from the number here. Okay. The next thing is what I want to do. Maybe I'll just move myself here. Now I need to compute the portfolio return, right? So let's give them some weight. So if I'll give them, let's give them equal weight. Let's say 0.5, and this is also 0.5, right? Then what will happen? Then my portfolio return will be, right, this times this plus return of the Walmart times this. Okay, so this is my portfolio return. To compute the standard deviation, the formula is a little bit complicated, but just follow me. So that's basically the weight square. So the weight, this one square times standard deviation of 1 square plus this square weight, second weight square times second standard deviation square, right, plus 2 times weight 1 times weight 2 times times, I'm just referring the formula as well. So the covariance, which is the correlation square times standard deviation of 1 times standard deviation of 2. Okay, and then everything I want is QRT. Hopefully this is the square root. Okay, yeah, in the square, enter. Okay, so this is my portfolio's standard deviation. Okay, so this is my, if I see this is in percentage. Okay, so as you can see, maybe I'll convert this. So to get daily 0.5, I have this 1.15 square, right? So So what I can also convert this in a percentage so you can see more, right? Okay, so pretty much if I see the Walmart, right, this is my risk. Okay, so Walmart is, if I take the Walmart, its risk is 1.6 or almost 1.7%. And even if I go together with uh, the Google is 1.7 and the Walmart is risk is 1.4%, right? But when I combine this portfolio together with the equal weight, my risk comes to 1.15, right? So that's way lower. So let's see some different combination. What if so maybe I'll just say, instead of this, I'll do this 1 minus this, right? Okay, so what will happen if I have, let's say, 0.7 here? You see, I return my with 1 basis point, but my risk is increase as well. So let's do it inverse, 0.3, right? So you see my I only reduce 0.1, my return is 0.05, but my return is risk is reduced to 0.01. So this way you can play it around with the numbers, right? So this is, of course, this is a daily return to yeah. So we can see how much either we want to increase the return or reduce the risk and so on. So if it was in Excel, we can also use the solver function, and then solver give us the appropriate weight here. I think that's not in the Google spreadsheet, but yeah, if you want, I can show you as well how to use the solver. Just put the comments and definitely like the video. So yeah, so this kind of a thing will ensure. So rather than have a very high weight in one stock, which I never recommend, need to ensure. So a little bit on the correlation side, the correlation, try to see if the correlation between the stock should be less. So this is not bad, and the best is the negative, right? So that's why people like to go for the gold or some other, which are purely as treasury stocks, right, which has uh, almost zero sensitivities, right? Risk almost virtually is a risk free, right? Anyway, that's a topic on difference, but at least if we can use these kind of just a little bit of spreadsheet, just follow along. It's not hard to create, and then we can reduce our risk, because Mr. Buffett said that increase there is 2 rule in the value portfolio, right? The first rule is never lose your money, and the second rule is don't forget the rule number 1, right? So how we should do that? We should only do that when we can, one way is to achieve, we can increase the return. That's anybody can increase by increasing the risk, which is or the standard deviation, right? That's the same. But if we reduce the standard deviation by combining our portfolio, so yeah, so that's why time to time I'll show you different portfolio, because those guys for sure they must have reducing the risk as well, right? So we need to see the full and complete picture. Okay, so let me know how you like this video so far, and if you like it, please give a thumbs up and provide your comments. And if you want to make me some other similar kind of video, yeah, put in the comment as well. Thank you for watching, and see you soon in another video. Bye for now.